We're indeed honored and privileged to have with us this afternoon Rajan Anandan, Managing Director, Sequoia. I'd like to request all of you to please give him a big round of applause as we welcome him to this event. And I'd like to invite both of them, including PK Gulati, Chairman, Emeritus, Dubai, onto the stage. And I'd like to hand the mic over to PK.
Hi, Rajan.
Hello. By the way, I thought the AI
It was doing
answered all the
It
questions.
was doing all the session anyway. So.
I don't know what you and I are doing here. We should just have we should have AI ask the questions, AI answer the questions.
Where's the startup which did that?
I met the founder outside, actually.
There, Ratsa?
He doesn't need to be in the room because he's got the AI here, so.
Good. I just wanted to say, like, if you could do the job, we could have continued eating.
Actually, that would be great. You know, next NPC, Devjani, you should have like a AI ask the questions and AI answers. So have one, you know, like have,
Competing.
Today, like you've got like, think about it, right? You have automated coding, you have all these things, text to video. You saw the new Facebook thing? It's like insane.
But you have
Actually, you know, you could run a whole NPC without any humans. Actually, you should have like AI in the audience too. You know, like everything is AI. AI asks questions, AI answers, also AI is in the audience.
NPAIC.
And you know, the cost would also be zero because like, you know, like you wouldn't have to serve food, you don't have to get this. Actually, I think that's called a Zoom conference.
NPAIC. Yeah. Anyway, back to real life. Good evening, good afternoon, good morning. Looks like nobody had lunch or had too much lunch. Anyway, it's good to be back. Rajan, thank you very much for specially making it here. You know, it's, you know, one is a flight and the second is traffic to make it here. And you still made it in time, so thank you so much. The lady in the AI told us that it's a funding winter. Do you agree?
Yeah, I think, look, basically, I think what we're in is we've gone back to normal, right? 2021, actually second half of 2020 and 2021 were really a period of extraordinary exuberance, right? Mm-hmm. We all know why. I mean, you know, $7 trillion was pumped into the US economy. That flew into lots of asset classes, including startups and so on and so forth. You know, 2022 is really more like 2018. It's not like a winter. In fact, if you look at the amount of capital that has been raised by the top 6 India-dedicated funds, right? So Sequoia Capital, India, you look at Lightspeed, you know, Excel, Elevation, $6.5 billion. Never in India's history has so much early stage capital been raised in a period of 7 months. Mm-hmm. So if you look at seed, Series A, and even Series B, there's more capital in India today than there's ever been. Mm. Now, there is a gap in late stage. So if you're looking at Series C, D, E, pre-IPO, and that's because a lot of the crossover funds have sort of pulled back, right, because of what's happened in the public markets. Yeah. So in that context, we're really back to reality, and what that means for startups is we're back to quality, right? You have to have a very high quality business to be able to raise a Series A, for instance. You need to have product market fit. Without product market fit, you can't raise a Series A. Last year, you could have raised a Series A without product market fit, with very little traction. Today, you cannot. Similarly, if you get to Series B or Series C, especially Series C and even in Series B, if you don't have strong unit economics, you're just not going to raise a round. Whereas last year, you know, lots of companies were raising rounds with broken economics, or broken unit economics. So what we're really, you know, so basically we're back to where 2018 and 19 was, so which I think is very healthy.
Yeah, so I'll pick up on the healthy part, but are you saying that we were making bad investments, or we were not making well-researched investments, or we were making investments because there was just...
I don't know about what you were doing. That is certainly not what we were doing. But we were in a period of extraordinary
I want to
exuberance.
See how you spin it. So I really want to see how you spin it.
Of course, you know, like... No, but we were on a period of, you know, extraordinary exuberance, right? All investors...
What does that mean, extraordinary exuberance?
Meaning, you know, valuations were high, deal velocity was very high, pace was very high, and that is, the whole world went through that, right? So that's why...
So are you saying it was FOMO, correct?
No, it
Fear
wasn't
of missing out?
No, look, I mean, no, it wasn't. I mean, basically, PK, the smartest investors in the world, the smartest entrepreneurs in the world, just assume that we could possibly be in a zero interest rate environment for a long time, right? So basically, if you basically say you're going to be in a zero interest environment for a long time, your discount rate pretty much goes to nothing, which means your terminal value is exponential. I mean, like, effectively, you could justify valuations that are very, very high. And the way private market valuations work, I mean, obviously, most of you know this, but public market valuations have a significant impact on private market valuations, right? So when the SaaS market multiples on revenue multiples were, let's say, north of 10, and the best SaaS companies were trading at 50, 100 multiples, right? 50, 60, 70x revenue multiples on multi-billion dollars of revenue, all of a sudden that has an impact on how private companies are valued, right? So all of a sudden, if I'm a late stage, let's say you are a late stage investor, and you are looking at investing in a, let's say, a Series C or a D, for you to pay, let's say, 12 or 15 times revenue was not unreasonable because the public market multiples for that company would have been 15 or 20 or whatever it was, right? So I mean, this is what happens. I mean, this is what happens in periods like that, right? Like everything kind of goes up, and therefore you have lots of decisions that are made. But of course, what happened was, as we know, inflation got very high, interest rates started going up. Some things happened that we couldn't have predicted. Which
like
is
the
Ukraine war
yeah.
and what's happening in China and the multiple COVID lockdowns. So all of that has had an impact, right? So look, I mean, whether it's in tech, whether it's in real estate, whether it's in, I mean, pretty much pick your favorite space, right? We have these cycles, and this was really a cycle that, took basically tech valuations to unprecedented highs. But the good thing is now we are back to normal. So it's pretty good.
So let me ask you a question as somebody who paid a lot of money for a certain startup. Now you can't get that valuation, or that valuation is unreasonable. Are you guys perfectly fine with doing down rounds?
So first of all, it's not up to the venture capitalists to do down rounds.
You sit on boards.
Oh, founders have to do down rounds, right? My partner Shailendra had a very interesting quote 2-3 weeks ago where he said, because founders obviously worry a lot about doing down rounds, right? And Shailendra said, like, doing a down round is like getting a B in 10th grade. Like, who cares? But at the end of the day, either you're going to be an enduring company, right? You're going to build a company that, lasts for 10, 20, 30 years, and you're going to generate insane amounts of free cash flow. And if you want to list, you're going to list, or otherwise you buy all your investors out. So it's a point in time sort of thing, right? And so what we see the best founders doing, PK, is most companies, I would say, that raised capital in 2021 obviously have to grow into their valuations, right?
Correct.
It could be 1 year, it could be 2 years, it could be 3 years. So if you have the runway to be able to grow into your valuation, you're going to do that. I think what we'll see probably starting in 2023 and certainly in 2024 is some of these companies will have to raise capital before they can grow into their valuation. Okay, so if you can't grow into your valuation,
which will probably not be that valuation.
No, because then you'll have to actually raise at a lower valuation. Right?
Yeah.
You're seeing this happen in the US all the time. I mean, every week you see a headline, right? Company that was valued at 30 billion is raising at 8 billion. I mean, all these companies. So I think it'll happen, but I think I tend to agree with Shailendra, which is, look, it is like getting a B in 10th grade. Like, I got a lot of Bs in 10th grade. I don't remember. I don't know whether it really matters. I don't think so.
You don't know if you had got an A in the 10th grade.
I mean, I never know. I mean, I could have been doing something else. Who knows?
Yeah, who knows?
Who knows? I mean, who knows?
Or you could be making statements like Shailendra, probably.
Actually, this is a good point. He probably got all A's. That's why he thinks that, getting a B in 10th grade didn't matter.
Yeah. So let's come down to founders out here. Now, a lot of these founders would be having this dilemma. Should I take a down round? I would personally say take a round if you need a round, and survive to live to tell a tale. Would you agree with that?
Yeah, I mean, look, basically, if you have to if you're running a company, okay, either you're going to be running a company or you're going to be not running the company you're running today.
Yeah, that's true.
There are only two options, So if you're running out of funding, and if you have, let's say, less than 6 or 8 months of runway, you should raise. And you should take capital. Even if you have to do a down round, you should do that. Even if you don't like the terms, you should do that, because not having, like, if you have 3 months, it's likely that you won't make it. Okay, if you have 3 months of runway today, you are most likely not going to make it unless you can extend your runway by right-sizing your cost structure, by accelerating revenue, things like that. If you have 6 to 8 months of runway, you should have started raising like yesterday. And I can't tell you how many founders don't quite understand this, which is, like, the option is either you're going to have your company or you're not.
Correct.
So, well, on the other hand, look, if you have 18 to 24 months of runway, and you've got a pretty strong business, meaning the unit economics work, the math works, all of that, you should not be raising now because...
You should be experimenting like hell.
No, you should be growing. I mean,
Yeah.
if you've got product market fit, you've got strong unit economics. For startups that are actually well-financed, I mean, this is probably more like 24, 36 months of runway. It's a great time to accelerate, right? Because everybody else is going on the defense. So you go on the offense, and you can afford to go on the offense because, you've got great unit economics, you've got enough fuel in the tank.
Better talent, better availability.
Yeah, I mean, although the engineering talent market still hasn't cooled down. I mean, I keep asking founders, like, is it getting, it's still very hot. I don't understand that, but I think it's probably because all the multinationals are hiring. I don't know why, what's going on.
So you run a program called Surge, correct? And Surge is a differential program where you actually talk to people. And now most of the funding that's available is now dedicated to early stage, and people are actually creating portfolios of companies which probably wouldn't have been happening if the exuberance was still on. What is Surge doing? How is Surge looking at this? Is it time for you to kind of add on to Surge? Or you increased, or is it the same?
No, I mean, pretty much, Surge continues as is, right? So Surge, for those of you that don't know, it's Sequoia's early stage or seed stage platform where we invest capital up to $3 million per company. And then we have a program, which is like a 16-week company building program. We have a very strong community, 127 companies, several hundred founders. And then we help you with all aspects, whether it's recruiting, talent, product, marketing, tech, etc. And then whenever you need to raise your next round, we help you raise your next round. So basically, we've been running we run 2 cohorts a year, 15 to 20 companies between India and Southeast Asia,
in
about
each cohort.
half. Yeah. Each cohort is 15 to 20 companies. And we are now in our 7th cohort. We have 15 companies in this cohort. And as far as we are concerned, PK, we are pretty much business as usual, right? Now, we'll have to see over the next several months, do valuations change at seed stage? See, what has happened is valuations have corrected significantly at growth stages. To some extent, and when you come, even at Series A, it's corrected significantly. And I'd say seed stage, it's beginning to correct. It's not, so maybe we'll have valuations go back to 2018, 2019 levels. That's probably likely going to happen. But we continue to, because, we evaluate between 3,000 and 4,000 companies to pick 15 to 20 companies. So we have decided that at Surge, we are going to stick with these smaller cohorts. Of course, 15 to 20 companies a cohort is still a large cohort, but relative to some other programs, right, it's quite small. And we are going to continue with the 15 to 20 companies. We're going to continue to kind of run it the way we run it, because our view is, this is actually a great time to be investing.
So let's go to 2023. So you continue investing. Everybody that I speak to, the funds which you also mentioned, who have a lot of dry powder, raised a lot of money, they're going to the early stage side. Most of the VCs here you talk to, everybody's talking about early stage. So in 2023, we have clutter at this level and nobody taking them to the next level. How does that solve? Are we actually building up to that?
Yeah, I mean, look, I think even today, PK, high quality businesses are able to raise capital, okay? So I think what's important, at the right valuation. So the primary reason you're not seeing growth stage, let's say Series C, Series D, Series E, the 50, 100, $200 million rounds not happening today is not because there aren't high quality companies, okay? It's because most high quality companies raised a huge amount of capital last year.
And they're sitting on it.
Yeah, I mean, like you got $200, $300, $400, $500 million in the bank. Even if they're burning $5 million a month, that's $60 million a year. I can go like 7 years, right? So that's the first reason, okay? I think the second reason is because they did raise capital at, terrific valuations. Let's call it that. Don't want to say high or low. It was what it is, right? So those companies, they're just not going to come to market.
Yeah,
right?
they'll have to
And
do a
what
down
would
round
happen
otherwise.
normally with investors is, see, I don't know how many of you know this, but the best way to fundraise is not to fundraise. To build a great company so that investors come and want to invest in your company.
FOMO.
That is the best way to invest in it. No, it's not just FOMO. It's just that because, look, you have to understand all investment firms, we have teams that are always looking at every sector to try to figure out what are the most interesting companies. Okay, so the best way to fundraise, I can tell you, even at the seed stage level, the companies that we really want to invest in don't want to take our money. Because either they They think they can bootstrap themselves or, whatever it is. So that's what's really happening. So I think what will happen next year is, what we're seeing, what's interesting about what's happening right now is, as we speak, PK, and this started about 3-4 months ago in India, the underlying quality of businesses is improving, right? Because today, having negative unit economics or...
People don't even pitch, correct?
No, I mean, it's not a good place to be, right? So everybody is working on improving their unit economics. Everybody is working on reducing churn. Everybody, if you're building a SaaS company, you're pretty obsessed with net dollar retention. So you're trying to improve your net dollar retention. So I think what will happen in 2023 is the underlying, and by the way, the new founders who are coming to market now to raise their seed round, let's say, much, much higher quality. Because today, if you're going to start up, you have to be very, very serious about starting up, right? You come with strong experience in that space. You've got very clear view on what you want to build, et cetera, et cetera. So I think what will happen, I don't think the current environment, which is, today we're in an environment where it's all about quality of business. It's the quality of the founders, okay? If you're building a transactional business, which I don't think any of you are because you guys are all building software companies, if you're building a transactional business and you've got negative CM3, right? I mean, I had no idea, by the way, what any of these CMs meant when I was at Google, because we either made cash flow or we didn't.
Or you did OKRs.
Yeah, I mean, like, whatever, generate $30 billion of free cash flow a year, you're in a pretty good shape. You don't have to talk about all these contribution margin levels. So if you're building a SaaS company, for instance, right? So let's say you're targeting mid-market and enterprise, and your net dollar retention is only 110. That's not a good place to be. That is not a very high-quality enterprise business. Now, let's say you're building an enterprise business. Let's say you raise your seed round. You're going to come to market to raise your Series A. Last year, if you were in a strategic market, if you had a strong founding team, and let's say you had, I don't know, $300,000-$400,000 of ARR, you could have raised the Series A, and your Series A could have been $10 to $15 million, and your valuation could have been north of $50 million, okay?
Correct.
There were a lot of Series A's that happened at that level.
Correct.
I'm talking about the market in general, okay? Today, that same company, if you're going to raise a Series A, you will almost guaranteed you're going to have more than $1 million of ARR. You cannot raise with 200-300K of ARR, okay? There will still be exceptions, but by and large. You have to be growing 3 to 4x year on year. 10 to 15% month-on-month consistent growth shown. Number 2. Number 3, if you're focusing on enterprise or mid-market, your NDR's got to be over 120%. Okay? Number 4, your sales payback has to be less than 1 year. If you don't have those 4 things, it is going to be very difficult for that company to raise a Series A. So that is what I mean by quality. And now we can take different kind of spaces and say, so basically we're in an environment of very high quality, right? So when you go into 2023, this will continue now for a while, because there are still founders in the market who think that 2021 will come back. 2021 isn't coming back for a very long time, right? We're really back to 2018, 2019 type environment, which was actually a pretty
good but reasonable
normal environment.
Good but reasonable.
Yeah. But right now, the pursuit of quality is very, very strong.
So let me ask you a question. So, you ask for personas of your clients. Let me ask you a persona for a startup founder today. What is the persona of an ideal startup founder who comes and pitches to you? Is it thing, we have been talking about deep tech a lot today. So is it that we've got more patience in the market now, that people like you may have more patience to kind of look at somebody to develop more IP, more detailed, more inventive kind of, stacks and things like that?
I think there's no one persona, right? I mean, we will invest in 22-year-olds and we'll invest in 45-year-olds. We'll invest in PhDs in AI, and we'll invest in, people who've run billion-dollar businesses, right? So there's no one persona, PK. I mean, it really is very, very broad, right? Like, all these people have these...
But do we see that kind of a change happening is what I'm trying to find out.
I think that, I don't know whether there's a change. I mean, you're seeing a broad basing of founders, right? I think if at all anything, what you're seeing is the type of persona is actually expanding, right? Like, a lot of people say, like, husband and wife team. We have so many husband and wife teams in our portfolio.
We had one in
we have
the morning.
single founders. I mean, we have all kinds. So we have brother and sister, we have brothers, we have sisters. I mean, like, we have all kinds of personas. We have business-focused 22-year-olds. We have PhDs from Stanford in AI, etc. So it's really quite broad. But, like, for instance, like, we are very active, right? Despite the quote-unquote winter, we are very active. We've made several investments in Surge over the last 3-4 weeks. The last company we invested in basically was 2 PhDs in NLP. They're solving, it's a US-focused company from India to the US. I can't tell you the space, then I'll probably give away the company, but they're focusing on a very, very large multi-trillion-dollar industry in the US. Why did we invest in this company? One, because the 2 co-founders were very, very, very technical, right? PhDs in NLP from top US schools, but then also worked in that industry and also in startups. So they have
domain knowledge.
They have domain knowledge, they have technical knowledge, and they've been in startups, so they understand sort of how to build, how to ship fast. So that's one. The other also part of the team was, like one of the co-founders is actually, he's deeply technical, PhD in NLP, like no joke. But he's actually quite good at selling. Yeah, so very kind of
ideal
commercially savvy and all that. I mean, obviously I have to learn a lot and all that. So that was one. And then the second, the market itself was very interesting. I mean, this is sort of a multi-trillion-dollar market in the US where, AI is going to have tremendous impact, right? So that's like, it's a very early company, so that was one of our companies. And then on the other end of the spectrum, we have a company that we invested in probably 2 weeks ago, which is, a young founder, but who's sort of spent many years at one of the leading e-commerce companies, who's doing a vertical e-commerce play in India, right? So there's a very different profiles. 2 PhDs in NLP, and I think this founder is, business grad, been at one of the leading Indian unicorns, focused on the Indian market for 3, 4, 5 years, but deep insights about this particular category where they want to go and build a vertical e-commerce company in. So that gives you a spectrum of, it's a pretty broad spectrum.
So let's look at the other big elephant which people are usually averse to talk about, and which is governance. We've seen these frothy years, this exuberance years as you call them, and there has been a series of issues of governance, and companies have grown faster than governance and rules, and building a robust company has happened. Now, is it time for us to actually kind of, as an industry or as a set of investors, kind of enforce a minimum kind of an expectation of governance?
Yeah, absolutely. Look, I think, maybe if you take a step back, if you want to build a world-class company, you got to have world-class governance, right? And I think what's happened in India is because the ecosystem, I mean, if you go back, like it's very interesting, PK. If you go back to 2011, India had no unicorns. Okay. Now we have 130 unicorns, right? If you go back to 2011, India had less than $1 billion of startup funding. Last year we had $45 billion of startup funding. I mean, so it's this exponential growth, right? And I think and what's happened as the ecosystem has grown so fast, we haven't been able to sort of build, number one, the awareness, right? I mean, to be fair, look, very, very few founders wake up in the morning saying, I'm going to do something that's not correct, right? But also, there's no lack of awareness. So what is it? If you're a seed stage company, what are those 2 or 3 things that you've got to do? If you're a company that's, raised a Series B, what do you have to do, right? By the time you're a Series C, for instance, you better have a very strong independent CFO. And independent CFO, by the way, means it's not your brother, it's not your co-founder, it's not your wife, it's not your, like somebody related to you. Okay? That's what independent is. Because, most startups, like one of the co-founders is CFO. By the time you raise a Series A, that's got to stop. Your co-founder cannot be the CFO. It has to be an independent leader of finance.
So we used to do a session, it happens in nascent ecosystems. We used to call it the session of your money, my money, and our money. Yeah. How do you behave with each one of them?
Yeah, exactly, right?
And so, it's a simple thing, but it's not as simple.
Yeah, like, let me ask a question of the founders in the room. How many of you have a whistleblower process in your company? Enough said.
Yep.
Right? So basically, you should have a whistleblower process from the time you raise your first institutional. If you have more than 30 or 40 people in your company, you should have a whistleblower process. Whistleblower process says anybody in the company who sees something wrong can escalate it. Okay? How many of you have a POSH committee? 1, 2, whoa. By the way, if you have more than 10 people, you're required by law to have a POSH committee. So this is what I mean, right? Like, I think it's the lack of awareness, PK. So the first step I think we need to do as an ecosystem is we need to build significant awareness, right? Because at the end of the day, I genuinely think founders, no founder wants to not build a world-class company.
Correct.
So I think that you've got to start with that. And then second, as investors, of course, we need to help our companies.
That's correct.
Right, put these processes in place, get independent directors, make sure the CFOs are independent, make sure the disclosures happen every quarter, make sure audits get completed on time. That's...
I don't know why you're saying that.
No, I don't know. I mean, sometimes audits don't get completed on time. So all these things need to happen, right? But I do think, look, as a firm, at least we've said, and as you know, right, like if we see things that are inappropriate happening, we will investigate, run independent investigations, and we will take action, right? Because we think that is absolutely non-negotiable, and that's why, earlier part of this year, you saw our firm in the news for a number of different things, because, we are very clear that, wrongdoing should be investigated and action needs to be taken.
Yeah. So before we end, what are the few messages that you would have for people? Now, there's no better time than to start now. There's no better time than to do this today.
Yeah, no, I mean, there's no question, right? I think, if you, I assume most of you are, building companies already. I would say, look, if you're an early stage company, focus on getting to unquestionable, extraordinary product market fit. Unquestionable, extraordinary product market fit. And if you don't know what it means to have that, then please find some mentors who can help you determine that. Because if you get to unquestionable, extraordinary product market fit, especially in the kind of B2B businesses most of you are building, right? We don't have any consumer, internet, commerce, payments type founders here. You're building mostly B2B companies, software, AI, hardware, software, whatever. You will be able to grow. So I think for early stage companies, that's the message. I think for a late stage company is just make sure you build a very powerful economic engine. An economic engine means the business works.
Yes.
It's very simple. So, and by the way, product market fit, if you're in a transactional business, means the business works, but sometimes doesn't have to be. Like, for instance, if you're building an enterprise SaaS company, or let's say you're building an enterprise AI company, a software-based AI company, what it means is, you better have 10 paying customers. Each of them pays you $50,000 to $100,000 a year. So by the time you get to $1 million of ARR, and let's say your NDR is 120 or 130, and let's say your sales payback period, you're probably just founder-led sales. It doesn't seem like boulding over a rock to get a sale closed. You probably have PMF.
Yes.
And now you're good. So those are the two things I'd say.
Very good. Rajan, thank you very much for all these nuggets of knowledge. I hope people have been noting that down. And thank you very much for making the effort of coming down here and speaking. And as I promised, I did not ask the question of rivalry between Delhi and Bangalore ecosystems. Yeah. Okay? Thank you very much.
Please give a big round of applause,
#1 on roads.
Rajan Anandan and PK Gulati. I'd like to request PK to present Anandan with a small token of appreciation. Thank you both once again for that brilliant session.